Craig, whenever you would like to start, please welcome Craig Ferrantino with Craig James Financial.
Hello, everybody. Thank you for being a part of this. We're just trying to get the information out here at Craig James Financial. First and foremost, I'd like to thank Susan for inviting me to be a part of this. It's great that she's doing this. And certainly this is one of those presentations that the advanced traders would go to, but we'll try and make it as simple as possible and maybe give you some resources to go in the future. So tonight we'll be talking about new approaches to investing. Before I do that, let me introduce myself. You could read that. I won't brag about myself, but I'm on the radio in the morning every day. I'm also do a couple of other things here and live out east. And right now I'm actually broadcasting to you from Sulphur Springs, White Sulphur Springs, West Virginia, at a place called the Greenbrier Resort, which is where historic, I know this is a library crowd, I could go into this stuff. You know, Sam Snead was a famous golfer and was the pro here for many years. And not too far from me, though, interesting, and I'll be taking a trip up, is the National Radio Quiet Zone, where there's actually no emissions anywhere. And it's 100 square miles, and it's for military purposes as well as astronomy purposes. So that's the the Green Mountain area of West Virginia, so not too far away from me, within an hour. I'll be heading there over the weekend just to check it out, but of course you can't use your cell phone. No microwaves, no vehicles, only diesel vehicles can be as you get closer to the area. Something to look at. Now, that's not why you signed on, but I just thought I'd mention that the great Greenbrier, coming to you from West Virginia, a state I haven't been into too much. So I hope you had time to read this slide, and let's go on. So tonight we're going to be talking about how not to sabotage your money or your portfolio. This is more for people who do some stock picking. We'll talk about some point and figure charts. We'll talk about fundamental analysis versus technical analysis and ways to minimize portfolio losses. Are you ready? Let's begin. So here's the 10 ways to sabotage your portfolio. I'll go through this kind of quickly. Let me get rid of this okay here. So first thing is important, we'll go over it real quick here, is that supply and demand drives the market. Supply and demand drives the market, very important. Trying not to know when you say not what team is on the field, I'll explain that in the presentation. You know, if you think the market is easy to figure out, everything goes up, actually the first 9 months of the year, maybe 5 stocks are going up, which represented the whole market. A lot of people thought they could just invest anywhere, and they found out that that wasn't the case. You don't want to make stock selections based on fundamentals alone, and we'll talk about what fundamentals are in the presentation. And you think that a stock is a, quote, good value. There's some problems with that theory. But people tell you it's a good value. You'll hear it on CNBC, you'll hear it on Fox Business, you'll hear it on Bloomberg, you'll hear I'll just call those the majors. And we just want to just talk about that a little bit. Doing this a long time, want to make sure that we're not going to make, at least anybody on this library call will not make any mistakes. So you don't want to, also don't be afraid to buy stocks that are doing well, that are hitting new highs. We'll discuss that. Sell stocks because it has gone up. There's a greater, some probabilities in there statistically that stocks that go up continue to go up. So if you think something's hitting a new high and you shouldn't buy it, well, it could be a month later and it kept hitting a new high. So you have to be careful with that. Hold on to losing stocks and hope they come back. You don't want to be I call that a stuck holder instead of a stockholder. Important to understand the idea of what that's all about. And you don't want to do anything based on the advice of a magazine cover. And, this is so true. And it just happened. If you have a chance, Google, the death of the 60-40 strategy that was in the Wall Street Journal just a few months ago. We're talking about, keeping 60% of your portfolio in equities, stock things that go up and down, and 40% of your portfolio in bonds. And they said it was like last, with the bonds going down, as the bond market lost about 13%, and you could be in safe, what you thought were safe government lost 13%. All these articles saying the 60-40 is dead. It's not a good strategy. Trust me, I know. You could just, it wouldn't take you 2 clicks as I'm speaking on a separate window to figure this out. Well, then lo and behold, this year is the best year for the 60-40 portfolio. So just go figure. All right, let's keep talking here. All right, so what happens if you sabotage your portfolio? You become poor. If anybody knows what movie this is from, please chime in as soon as possible. If you know what movie this is from, classic movie. It's in the 1920s, let's put it that way. And that actor is Jackie Cooper, young Jackie Cooper. It was a silent movie, one of my favorites. And by the way, it's in the public domain, so you can actually watch that movie on YouTube. And that movie is called The Kid, written, directed, music written by same person, directed by same person, starring the same person, Charlie Chaplin. It's Charlie Chaplin, The Kid, and it's about that the orphanage has taken this kid that he's adopted away. There was no money available, and Charlie did not have custody of the kid. Classic scene, and that kid was really crying in the movie, trust me. The acting was so good, they probably smacked him. All right, law of supply and demand. First rule is how we do things, law of supply and demand. If the price increases, the demand goes down. So they say, oh, let's just keep buying it. If you find that if oil keeps going up, it comes a point where people will use alternative energy. It's okay, we'll use electric. If the price of oil comes down, then the supply the demand goes down because it's cheaper. So that's how everybody needs to know supply and demand. And this is some of the alternative approaches to investing, is an understanding of the basic of supply and demand. Price decreases, the supply goes down, and the demand goes up because it's cheaper. You want to buy more and more. Somebody like an Apple, there's a famous book and this is not in the presentation, by a gentleman by the name of Porter, called Competitive Strategies. And in competitive strategies, they said you're going to be 2 things in a market. You're going to be a low-cost provider or a very high-quality product. So when you think of Apple started, they said, we have very high-quality products. They're not cheap. The Apple iPhone is not cheap, blah, 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 blah. And then a bunch of other phones came in there, like Nokia, if you remember those days, and a lot of other people undercut them with doing the cost provider. So think of some markets. Is Target a low-cost provider, or and that's how they're going to go. It's depending on how you slice it. Unless you have some sort of competitive advantage, you're going to go for that. So the supply and demand is very important. It drives every market. Produce in the supermarket, same thing. Fundamental analysis, what to buy. Fundamental analysis based, hey, let's, I work for, Prudential, I don't know, some company. I'm a Morgan Stanley analyst, and you see them on TV or on what we call the majors, and they'll be talking about some investment. It looks like it's very casual and colloquial. They tell you what to buy. They'll talk maybe a little bit about the company management. We know Nike have recently fired their president, CEO, and now they have a new one. And so the Nike stock had been on a negative movement there. So we could talk about those. Anything that you talk in that language, the earnings quality, the PE ratio, stock is trading cheap to forward earnings, any of that comments that you hear on the majors, that is all fundamental analysis. All fundamental, with the exception of maybe 10 minutes during lunch on CNBC, you'll hear some technical analysis. Technical analysis doesn't even ask you what's the name of the company. They're looking at how the stock is moving relative to the market. So the name's not even important. It's the pattern that's important. So that's what technical analysis is. There's a couple of them. You'll sometimes hear the 50-day moving average when the fundamental people are talking about it. Oh, it crossed the 100-day or the 200-day moving average. That's a technical analysis. That's just looking at a fact and the price movement of the stock. There are other ones out there, which I won't go into. Fibonacci sequence, Fibonacci series is one that some people I know follow. And there's a billionaire on Long Island, Renaissance Capital, who is a math professor at Stony Brook, who has these very advanced formulas and feels that his hedge fund does better than others. That's another discussion for another day, but you need a lot of money to invest. So what is the local guy supposed to do, the local lady supposed to do? And that's what we're here to talk about today. So they're using technical analysis and computer programs to figure out stock movements in a given market. So it's sort of like how it's not just a piano, it's a symphony. On the bottom left, you'll see that looks like a Steinway on the left. And you'll see fundamental, this is giving you numbers, price earning ratios. You can see that on the right is the price of the stock. Don't even mention the name of the stock. This is just the movements of the stock. And you see a bunch of X's and O's. It's not a standard chart. This is a supply and demand chart, and we'll get into that. So technical analysis wants to tell you when to buy, looks at some trends, relative strength. So today, I'm not going to go into earnings per share, and we're going to go through all these ratios and current ratio and debt on the books, which would just put everybody to sleep. We're going to look at art. We're going to look at numbers and how they move. Does that make sense? If you're online camera, shake your head if that makes sense. We'll show you some art. Okay, perfect. So why is the stock going down? Why the fundamentals? This is what we're saying. All the analysts love this company. Why is the stock going down? We're going to take a look at some of these. This is the daily price of a company. And you say, okay, well, on this day, I don't want to even confuse anybody with dates. 45 closes one day at 45, next day at 44, 21, 43. So it kind of gives you an idea of where the stock is going. Is there any method to the madness on the closing prices of the stock? Eventually, you see 45 eventually goes on the bottom right side of your screen to 64. So what was it about some of these numbers? We saw it go to 44. We saw it go down a little bit. It went even down to the 30s. Can you see that? 36.52 on the left column, 35.42, 34, 32. What is the method to the madness? And if you could put down the supply and demand chart on what this is those prices now on a chart. So the daily price movements on what we call a point and figure chart. Now, point and figure was founded by Charles Dow in the 1800s. And this is a way that he would look and do his analysis on the technical side, not on the fundamental side, on the technical side. So this is from the 1800s. Charles Dow started to track the price movement of the stock. As it's going down on the far left, evidently, something's going on with the company. You could start to see the shares go. And as they're starting to go down at the 35, 36, 37. So let's go 1, 2, 3 columns over from the right. We're not saying anything yet. You and I are just looking at the numbers on a given day and what these prices look like, right? So 43, 44, 39. So 39 hits 39 again in the third column on the left going right. And then it goes to 38, 37. Okay, there's some softness there. And then 38, 38, then 38 takes you down. So if you could go from the 38 to the 37 to the 35, there's a little bit of a trend there. So that trend holds for a little bit. And then you see 36, 36, 36, and you start to see the numbers going back up, 37, 38, 39. Again, drops back a little bit, but now you're starting to see a trend up. And that's what the point and figure chart's doing. Don't even know the name of the stock. You don't see anything here. It doesn't say Apple or anything. It's just what's happening. We, over the years, I've identified some very, very good patterns, and I think it's been very, very clear as you start to see this stock price go up. All right, so now we're going to do, this is John Deere. Start to look at some of these numbers. This is not the same dollar amounts. And you start to see the zeros that you see on the chart translated. The zeros, this is a point figure basis. The X means the price is rising. So if you go back to the last chart, you could see where the prices are rising and prices are falling. The X's, the zeros are where the prices are falling. And then you see alternate columns of X's and zeros. And so Some of these on the bottom is just the date. So if you see a number in here, you see 6, that means June. That's in the middle of the chart in red. 7. So these are the days in June, and they're tracking the price of the stock. Evidently, there's a lot more supply in John Deere as this goes on. Now at 7, you start to see it hits a bottom in the first week. And then for some reason, it breaks through all these X's. I don't know if you can see my pointer, and then starts to shoot straight up. Then it keeps going. So now I want to look at announcement. Is there something new? Do they have a new product coming out? So I'll look at this chart, but I will know that if I'm sitting here at this X. Oops, so sorry. Let me go back one. I will know that if I'm sitting here in the middle of the chart between these X's and zeros. So I almost want to let, and I tell my staff this, I almost want to let the stock price goes to, if I draw a line here, 315 to 318.32. Because now I'm breaking out of this batch of zeros. I did not catch the bottom, right? But I'm seeing that it's holding strong. So to me, this is a better buy at $318.32 than it was, let's say, if I knew where the bottom was at 291. So Craig, that's crazy. You're saying it's a better, I understand the pattern better if it's starting to break out, but I won't see that clarity until around the 315 to 318 mark with the systems that let's put it that way. I'm sure Renaissance, the billionaire hedge fund guys, they have better systems, but for the most part, we've been pretty good with this. So it's a better buy at $315 or 318 because I'm breaking out of these zeros here. If you look to your left a little bit, you'll see a 0x0. As soon as I get past there, I know I've broken a pattern. So that happens between 318 and 321. This is advanced trading strategies, what you signed up for. And I'm showing you technical analysis of John Deere back in 2022 when we printed this chart. All right. So market and sector forces together typically cause about 80% of the price movement of a stock. So it doesn't necessarily, sometimes headline news does that. We see that with NVIDIA. They had some short-term headline news last week or so. But came back down, and then the guy said, the owner said that the AIM was looking pretty good. We're still getting a lot of chip orders. So company fundamentals, what they spend most of the time on the majors talking about, usually account for less than 20% of a stock's price movement. What counts for the stock's price movement is supply and demand. Very, very important to understand that. So again, most people, however, spend 75% or 80% of their time on stock evaluation. We used to have clients that used to go to the library and get value line, and they would go out and get value line, and they would show me the picture of I pulled this from the library, and this gives you, and they spend on it. So it's good. Okay, this is why I like Con Edison. Good. Okay, I like that. Good for you. Now let's buy it then. They'll have their own research, but it's believe it or not, most of it's the price movement. So let's take a look at how to do this. Market analysis, we always want to look at market analysis. How's the general market doing? Sector analysis, how's the sector doing? Fundamental analysis, how's the company doing? So the overall market, how things look, are we going into more debt? What's the future look like with the economy? Are we in a recession? How are we at inflation? How are we dealing with that? That's the sector, that's the market. The sector is, we're looking at utilities. How do utilities look? Okay, then let's look at Con Edison. How is Con Edison doing? Let's see how their numbers are doing. Then I'll marry that with some technical research. Let's see how what's the stock movements look like? And then we could do some sort of risk management from that point on. So market analysis, we talked about the buy and hold. You could have bought the market in 1929. It took you 25 years to get back to even. Buy it in 1973. It took 7.6 years to get back to even. So you could have lost money in the market crash, but stayed in the stock, and it would have taken you 25 years to get back to where you were. That's a long time. For some people, some people didn't make those 25 years because we had some wars in there. So when you go back to it, and in 1997, IBM went down 74%. Took 10 years for IBM to recover. Buy it in 2008, took 3.5 years to get when it went down in 2008. It happened, snapped back much quicker. So these are just some examples. Buying and holding is not necessarily the best strategy for people looking to make money. You don't have a profit until you sell something. All right, here we go. This is a little financial comeback, how long it would take you. Well, you're at $500,000, and this is a calculator you can get on the New York Times, and you went down to 310,000. How many years would it take you to come back, calculated with some sort of, at let's say 4.7% annual return? That's including the ups and downs. It would take you 29 years to get back even. If you have $100,000 and it goes down to $50,000 in the market, you're down 50%, right? You're getting half off of 100,000. However, if you to go back from 50,000 to 100,000, if I do well, you're down 50%. Craig, could you make me 50%? 50% from 50,000 only gets me to 75,000. I actually need to do 100% on your money just to break even if you're down 50%. Now, which is okay if you're 24 years old, but not so good if you're in your 50s, 60s, 70s, etc., because the one thing that's not a good predictor is time. We know over a long period of time, I want to correct myself, over a long period of time, we can predict your outcome and your success very, pretty well. But over a short period of time, and you have a shorter period of time, again, if you're an older investor, so please keep that in mind. Does that make sense? I hope so. So so how should I do leg one is equity exposure, managing your trades, leg 2 and 3, domestic equities. This is just a broad-based portfolio and different investments. I also have commodities in there. If you notice that lately gold's been on a tear, probably due to the weakening US dollar. That could change though, so just keep that in mind. So look at your equity exposure and how this looks. All right, so we want to make sure one column, this is the double bottom. Here's the double top, as I was showing you earlier when the stock was a better buy at a certain price. This is what we look at here. So it's it hit a X again, and then a couple of days later, 6 trading, 1, 2, 3, 4, 5, 6, 7 trading days later, it hit that second X. Doesn't mean anything, but it's the $35 mark. It's a better buy at 35 than it was at 34. It sounds crazy, but that's how that is. On the other side, we want to take a look at when to sell. If we're buying and holding, a strategy may not be good, as I just illustrated for you. So here we hit a double, blah, 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 blah. So I have a better understanding at 34. If I was looking on not keeping the stock, that might be a good time to get out. So that's the double bottom. There's a triple bottom, triple top, double top, very bullish signals. So here's a situation where you can see it's all over the map, and you could see the different the risks in the market. This is the New York Stock Exchange bullish percent chart. You can get the bullish percent. A lot of, by the way, who does a lot of this is something called relative strength. Investors Business Daily, which you could find at your library as well, and also online, has a lot of relative strength, and they do a similar thing with the point and figure charting. Very well-known publication, been around for a long time, and actually carries stock-related news as opposed to a lot of other stuff like the Wall Street Journal does. It's all sorts of news there. Here's a company. This is very interesting. Let me go back one. Here's a company that and I'm sorry I couldn't copy this well, but I wanted to grab this chart. It was starting at $60, $78 on the top left of your chart. What I had here was that different analysts kept telling you to buy it. So they said at $76, reiterate buy. And then it went down to 74. Sector goes to bear, confirm status here. But the actual trades I should have another cartoon, which I used to have on this chart. It'll tell you that Oppenheimer reiterates buy. And as the stock we see the stock, you see all those zeros? The supply keeps increasing, yet the analysts, Merrill Lynch says buy, Merrill Lynch says hold. You start to see these analysts as the stock, you're starting to see them, somebody's dumping all these shares. When you see it to right, you see 45 down to 30, you still see the analysts speaking highly of it, even though their banks are dumping it. And this was classic Bear Stearns in 2007, which eventually went down. So it wasn't, I remember reading this, when the stock hit $6 from $74, $6, you could see all the zeros. People are dumping, somebody knows something they're getting out of this company. And you don't see until about $6 where Oppenheimer says to sell. Nobody put a sell rating on it the whole way down. They kept affirming it. And I have a chart for Enron. I have a chart for all the companies that you probably remember from days gone by, which look very, very scary as hard to go down. And and these aren't meme stocks. This is, so the people who you relied on giving you the fundamental analysis, behind them were people who were selling, and they were trying to use the small investor to support the stock price so they could get out at a higher price. So somebody, if you look in the middle of the chart here, I don't know if you see my pointer, but oops, sorry again. So let's go back one. Middle of the chart. You see a bunch of zeros here. There's a time here that just when that analyst said they were dumping the shares. And so you see the X's pick it up a little bit. These are people, again, saying, please, we're doing well. This is going into the months of July, August, through the summer. And those are your local investors buying up the stock, but maybe somewhat based on what the analysts were recommending. So we're starting to see that. This has all been litigated, so I just want to give you a hand, so don't jump on it today, but it is the reason why I'm showing that is because that was litigated and proven to be factually accurate. U.S. stocks, okay. So different class, you want to see which class should I be more in fixed income right now going into election. We have a lot of clients moving into fixed income as a purpose, or just raising cash. I was a little worried about the markets. We've handled some of those calls in my practice, foreign currencies, commodities. All right, so who's going to be a better football team next year? Kansas City, the Dolphins? Who knows? But let's take a look. All major stocks have a ranking system, as you could tell. Also, sports do. Tiger Woods, going back a couple of years since I'm at a golf resort. Phil Mickelson, you remember some of these names. That's not Pete Rose, number 6, by the way. That's another guy, John Rose. Cash U.S. stocks, what percentage should I be based on the relative strength calculation? I'm also looking at the New York Stock Exchange bullish percent. So relative strength is a what ranking system? What's the relative strength? Again, the relative strength numbers, it's just another number, but it might be useful, particularly if you're doing your own stock picking. And then this talks about bonds. Where should I be in the future? What percentage should I be in stocks? What percentage should I be in bonds? And where do we go from there? The idea is to make money. That's why we're investing. The first thing to do if you're going to invest is you want to make money. That's why you're investing. That's how the economy was created. People invested in things. The building I'm in was from the old railroads, and it was built by CSX, and they own part of the buildings now. CSX was a like Northern and Southern Railroad Company. And it's a huge building, became an army hospital. People invested in this economy. It takes investment, involves risk. We're just trying to help you reach your destination by showing you some advanced strategies, and by using point and figure and some technical analysis, as well as your fundamental analysis for your investments. So if you're confused, you're always like, or you always look like that, that looks like the guy always looks like that. If you have any specific questions, please let me know. I'll be happy to take a few questions live now. And you could always go back to our website, craigjamesfinancial.com. That's craigjamesfinancial.com. You could email me at craig@craigjamesfinancial.com. If there's any questions no question is too silly. I'm very interested in what you have to say. And obviously all the library patrons are some of the best readers and the most knowledgeable in many different areas. We're more than happy to answer any questions you have.
So anyone that does have a question is able to unmute themselves to ask Craig?
I have a question. So I am new to the stock market and investing. This was a little above my head. I kind of need like how to invest in
Who
the
is
stock
this?
101. My name is Lisa Miskey. Hi.
Hey, Lisa, welcome. Thank you. Okay,
Thank
good.
you.
I don't see you. I don't.
Doing this. But what would you suggest? Like, do you do any like kind of, investing stock market 101 type classes, or is there like, where would I
Yes.
start?
Yes,
Okay,
yes, we'll get that on this, Elisa will get that on there as well.
okay.
So let's make sure we do that, yes. This was advanced trading strategies, this is,
Yeah,
right,
I
this right?
know. I know.
Lisa's
I
up,
thought maybe I
good, I
could
want to
pick a
make
few
sure.
things up, but it was really above my head.
Okay, yeah, but if you ever need, I'd be more than happy to put something, I have something. We had, getting fiscally fit, was it last week or 2 weeks ago now? For
It was last week and that
Yeah.
was recorded and it is now live.
Oh, okay. All
Right,
right.
go to that. So that's just the basic primer. Purchasing stocks or learning about stocks. I don't know if we have one of those live, but we could certainly, we have one in the can. So I'd be more than happy maybe in the next go around, Lisa, if we
Okay.
want to do that.
Okay, thank
Susan,
you
we
so
could
much.
have something, if you want to do that. And you could always call our office if you had any specific questions as well. We're more than happy to walk you
Thank
through
you.
something. Anybody else? Thank you. It's a great audience. Love the question and answers. Was it useful? I see people crying.
It showed
No,
us
can't
how
do
much
people
we do
crying.
not know. So
It's just important to understand that stocks, it's not all that you see.
Mhm.
And as you know, my opinion is that, a lot of the press I see is somewhat biased, no matter where it is. So we want to, I could still look at the temperature outside and say it's here it's 68 degrees outside right now, and that's a fact. So if I could look at some things that I could be a little more concrete with, I truly appreciate the technical side of the business. Certainly if a company has no money and they're insolvent and they're still trading at some big dollar value, I'll look at that as well. And that's your fundamental side. But supply and demand, I'll give you an example how supply and demand, there was the meme stocks, and one of them, famous one recently, was GameStop. And there was a bunch of the hedge funds got on there and they were shorting it. And yeah, the company wasn't well run. They were having problems. People aren't going to, you don't see what's that, not Best Buy, what's the Blockbuster videos much anymore. Well, GameStop was like a Blockbuster video. But then and they were trying to, I don't know, these hedge funds came in, they want to make money, and they were betting that the price of the stock was going down, and they were making moves to bet that the price of the stock was going down. And there's a bunch of local investors, they call it the meme army or the green army. And they came in there and they bought the stock, and they drove the stock price up of GameStop from, like, I don't know, $10 to like, $98. And it crushed a lot of the, they were sticking it to the hedge funds, but in the end, the fundamentals weren't holding it up. But it was thing to watch that from a fundamental side, because they were there, the little investors, like it was one of those classic, David versus Goliath, and people are rooting for, not so much for the company, but they wanted to take these profit hungry people. I mean, everybody's in business to make money, obviously, but taking advantage of a company that a lot of gamers were familiar with. And I thought it was very exciting. It was only a few months ago. Very exciting. Hopefully somebody writes a book on it. Well, you've been great. I appreciate it. Susan, thank you so much. Everybody, if you have any questions, feel free to give our office a call. 631-393-2888. We have a QR code. Takes you right to our website. If you take a picture of that, it wouldn't be a big deal while it was up on your screen. And we're looking forward to meeting all of you again. If not in the office, back at the library.
Greg, thank you so much. We appreciate your time.
All right, thank you.
Bye-bye, everyone.